Hey everybody, and welcome to the fourth video from Chapter 3. In this video, we're going to be talking about the inverse relationship between bond prices and bond yields. We're going to specifically be focusing on the coupon bond market since that's what a lot of the big players use to issue debt. And so as an overview, we're going to first take a wide-angle look at the active bond market, specifically with coupon bonds, and then we're going to talk about their prices and their relationship with the yield to maturity before moving on and talking about secondary markets and a couple concepts within them before closing with an example using treasury bonds. And so looking at specifically the secondary market for coupon bonds, they are generally going to have very large maturity dates. So we're talking like, 20 or 30 or even longer than that in terms of years. But most investors, they're just not going to be holding the bond that long. Like, I don't know about you guys, but generally I'm not going to be holding on to a bond for 30 years. That would mean I'd still have the same bond when I'm, 54. And so because of that, at some point I'm going to want to sell it. And this creates a significant need for a large secondary market for fixed income securities. However, interest rates with the yield to maturity are going to change over time as the issuer's financials change. So, as a first example, in 2019, let's just say American Airlines issued some 30-year coupon bonds that pay 5% interest or have a yield to maturity of 5%. You then buy one with a face value of $1,000. But then, after COVID hit in 2020, American Airlines had to raise more debt, and so they issued some more 30-year coupon bonds. But this time, because American Airlines financials got worse, investing in them became riskier, so their yield to maturity became 6%. We're now sitting at the end of 2020, and you're trying to compare the two because they're both maybe be put on the market. Now, you as the seller of the 2019 bond are going to have to increase the yield to maturity on your 5% bond to 6% to compete with the 2020 bonds. Because if me, as a potential buyer, compare the 2019 bond with the 2020 bond, I'm always going to choose the 2020 bond because it has a higher yield to maturity. And so let's look at what the present value is now. Remember that beforehand, the present value was $1,000 when the yield to maturity, or price when the yield maturity was 5%. However, when it increases to 6%, so denoted in red, and we take 1 year off of that because it's now 29 years left until the maturity date, the present value drops to $864.09. And so if we do some simple math, the value of the bond has decreased by $135.91. We call this a capital loss of $135.91. So since their financials got worse, the bond became riskier, and so you had to sell it more cheaply on the market compared to what you would have normally wanted to receive for it. And that's what generated the loss. And so the big takeaway that we can use from this lesson is that bond prices and the yield to maturity are going to always move in opposite directions. And we can do this by looking at the first derivative of the coupon bond value with respect to I. Now, the first derivatives equation is in equation 1. If you need help with this, talk to me. But as you can see, it's going to always be less than 0. And so when we look at example 1, let's not change it. Let's say COVID didn't happen and American Airlines got stronger, then the yield to maturity drops to 4%. In that scenario, at the end of 2020, the price of that American Airlines bond would have actually increased to $1,169.84. And we would have received a capital gain of $169.84. So instead of a capital loss, we would have gotten a capital gain when the yield to maturity dropped because the bond became more valuable as it's less risky. But we're also just broadly interested on how secondary markets price these fixed income securities because investors are just like broadly trying to make money. And so one of the big concepts within this is financial arbitrage. And financial arbitrage is just the process of buying and selling securities to profit from price changes over a brief period of time. And so let's just say that the bond's yield to maturity dropped to 4%, but the market has not priced it in fully. And remember, on that $1,000 bond at 5%, it's priced at $1,000. Let's just say now, because it's not the market hasn't priced in the drop to 4% fully, we can buy the bond for $1,100 because we know it's going to drop to 4%. And then after the market prices in everything correctly, it gets resold at $1,169.84. So we can get a capital gain of $69.84 just on what we call arbitrage profits, or knowing that the market has not fully priced in an asset's value appropriately. Now, this should set off all sorts of red flags and warning signs for you because this is exactly how insider trading makes its money. If you get some piece of information, let's just say that you're, some sort of medical expert and know that countries are about to go into lockdown but haven't publicly announced it yet, it would be very beneficial for you to short American Airlines stock or bonds. In other words, sell against them, bet against them, and then when those lockdowns go into place, the yield to maturity is going to go up, and you can buy all the bonds back at a cheaper price. So this is the whole basic of insider trading. But as long as you're just smarter than the market and not more informed than the market, you can take advantage of financial arbitrage. However, as a downside, it's obviously pretty risky if you all have the same information. Now, in closing, let's just look at some real US Treasury data. So this is going to come from February 3rd of 2020, and it's looking at 30-year Treasury bonds. This is, if you were to go on some trading platform, this is how these bonds would get priced. So, for example, Bond A, its maturity date is going to be August 31st, 2023. So, if you think back, if this was issued 30 years ago, somebody's been holding this bond since 1993. The coupon rate is being listed at 2.75, and so that means that the coupons are 2.75%, so 0.0275 in decimal form. The bid and ask spread are always going to be pretty close. What's going to end up happening is on the actual market, the ask price is always going to be what is met. Otherwise, there's not going to be a contract. But the bid market is people trying to get the bond for a little bit cheaper. This is just going to be the change in the value since the bond went on the market, and then this is just the yield to maturity, just now using the acronym YLD, using the ask price. And so you can see, based on all these different prices or all of these different dates, the yield is going to change. And so just as a, quick example, we'll run more through these kinds of examples and look at changes in Treasury in the next video.